All right. Yeah, I mean, even if you just do 10% of it, you end up in a way better position. Even if you just track your marketing funnel or you just track your referrals. Like one of the questions I asked when I was doing this was, well, how do I look at who has referred once versus who's referred twice? Because that is not a 50 or 100% increase in value of that client. Like that's a pattern. That's a valuable thing. So to everyone who just joined, welcome. You actually missed all the interesting things. We talked about everything interesting in the show prep. There's
That's a
nothing
show.
more we can cover. So I hope you guys have a fantastic day. No, I'm totally kidding. Welcome, guys. This is just going to be a really fun conversation. You guys have the ability to add comments. You'll see on your screen, there's that little comments section. Feel free to just ask questions, join in the conversation. I think if you want, you can ask to be added to the stage if you want to come in and have a conversation with us. So if you see a button and you want to ask us a question, feel free to mash it. But Jack and Nathan, thank you guys so much for joining me. Jack, would you be willing to introduce yourself real quick?
Sure. And thanks for having us. Jack Senge, I've been an advisor since 2009, which I always joke is like the worst time to start. Everyone just yells at you because financial crisis just happened. Been in the independent space since 2015. I manage a book of about 500 million, myself, my brother, and another advisor. And then we have a network of about 80 independent advisors that work with our firm on kind of like the corporate RIA. So we started working on Vitals, which is an automated practice management / reporting tool for advisors. Because a lot of what we're going to talk about today is like, I'm more interested in focusing on the client relationship, and measuring how I'm doing became relentless and difficult. So I figured let's build a system that can connect to what I'm working on and just automate all that data for me.
I love it. And the fact that it's been built internally is such a good litmus test on a platform. It's like, no, it's not a Silicon Valley play where we think the venture capitalists are going to love this idea. It's like, no, I needed it. Chances are someone who's in my shoes is going to need it as well. Nathan, nice to have you as well. Will you tell us a bit about yourself?
Sure. Nate, thanks for having me as well. Nate Donahue also joined the financial services industry in 2009, same time as Jack. Started at a really large insurance broker-dealer. But then we spun off and started an RIA back in 2021, just a scratch firm. So that was a really cool experience. Got to be the chief compliance officer for that business, so oversaw like our SEC examinations and all that interesting stuff. I sold that business back in 2025 Q1, so just a little over a year ago, and I met Jack shortly thereafter. And he showed me what he was working on with Vitals. And I was like, where the heck have you been for the last like 2 or 3 years when I've been making all these calculations manually by hand in Excel? So we just hit it off, and it's been a lot of fun to work on the project.
Awesome. Well, thank you so much for being here. And the fact that you went from 0 to 500 million in 5 years?
We brought over, I think, about 160 to 180 million. So it wasn't a fresh scrap or a fresh start from zero. But we had really fantastic growth, which we can talk a little bit maybe about why. We were a very niche focused practice, for one, and two, one of the things I'm really proud of is we invested very aggressively in our team. Like our team members drove a lot of that growth, which was cool to see.
Well, I will definitely be picking your brain on that, because my obsession over the last year has been, why are there certain advisors that grow so fast? It kind of looks like magic, where you look at them and say, wait, how is this happening? What are they doing that's different from me? So that might even be an additional conversation beyond what we talk about today. And it seems the binding theme of our guest list today is that we all started in the independent space or in the advisory space at horrible times, because I went independent in 2020. And so I did not have a great time. Nate, I'm sure you dealt with that a little bit too, just seeing what launching a firm looks like in the middle of a pandemic. And that's how I ended up where I am today, because I didn't have any outs left for my RIA. I couldn't go and do dinner seminars. I couldn't do in person. I couldn't go around and knock on doors. So a lot of these things I'd been trained on were just no longer the option. So I made a TikTok account out of desperation. And fast forward a couple of years later, I'm one of the most followed CFP professionals on social media. So I think we have a lot of really fun things to talk about today. Cool. Let's jump in a little bit. So I was pitching this to you guys, and for a lot of you guys who are in the audience, you guys also got my email kind of walking through how I was thinking about this presentation. And it's really hard to try to put the idea of the value of a firm on paper. One of the only times we do that is when we go to sell the practice, right? And that is one person who might be assigning value to that firm. But there are a lot of people in the interim who do as well. There are team members who say, well, I want to grow. I want to grow my revenue. If I'm an advisor, I want to be able to grow with this firm. I want to see that we are moving forward. And so the team members are going to buy into the clarity and that growth support. The clients are going to buy into that consistency and that accuracy, which comes down to a totally different type of clean data, which is, do I know what my clients need? Do I know how I'm serving them effectively? And is there a way to do that more efficiently so that I can either serve more of them or I can serve them better, right? And then, of course, acquirers who buy the company have a pretty straightforward way of evaluating it. So both of you guys have had $500 million firms or are currently members of $500 million firms. Starting with you, Jack, how do you evaluate your company? How do you look at that value?
Yeah. Well, it's funny because Nathan and I talk a lot about this. We started our own podcast to kind of flush out a little bit of what we were working on with Vitals, but we have two completely different structures for businesses. Like Nathan was very niche focused, very kind of planning and methodical on service deliverables. And we've kind of been almost the opposite. You know, we started in a very certain area of the country, which is basically the coastal area around Tampa Bay. And we've done a ton of reinvestment back into our clients. So we do a lot of events. They're pretty high-end events where we rent out. We did the Yankee Stadium last time, and it's like bring a friend type thing. So our business has always been very, very high referral rates. I was actually looking at my vitals before we came in here, and I had 8 new clients join, just myself, in December, and they had all come to our summer event in 2025. So we've always tracked a lot of who's sending us clients. So referrals are huge for us. Referrals from centers of influence. So we're very closely connected with a lot of CPA firms, a lot of estate planning firms, maybe tax or business planning specialists in the area. How many referrals do they send to us as well? So maybe that CPA has 50 grand with us. That's just some side money, but he sent us 25 clients. Like that's super valuable. And then, you know, getting into the details on, since we're not proactively out slamming, social as much as we probably can. So Nate will probably be customers of yours at some point. It's trying to make sure, like, are we actually growing wallet share with our existing client base? So we religiously track net new assets, how much is coming in. Are we developing the relationship, or did we get money one time and the clients just spent it down and we're in the negative year after year after year?
Got it. So you've solved growth with referrals primarily.
Yeah.
Clearly the profitability is high enough that you can reinvest aggressively and you can go and do large high-end events, which I'm sure only adds to the retention, right? Each of these are related. It's really hard to pull any one of these elements out. And then it sounds like your clean data layer has just been nuts. I mean,
think about it. If you're scaling up, you can't go from like, I have no clients to like, I'm going to do a bougie seminar. You're going to be in the red. So we were harder with marketing when we were starting and scaling the practice. As the client base gets larger, for us, it was kind of the middle bullet there. Like, how do we make sure the client experience with us is completely different? It's, we're really creative on gifting, really creative on our events. We have a lot of like pop-up things that we do throughout town. So we have enough of a client base now that if you do the right kind of reinvestment back into those clients, it starts to drum up, okay, now we have the kids. So how many people in the full family tree do we have? Grandparents all the way down to grandkids. How many clients are sending us more assets? How many times a client passes away, do we retain it with the second generation? So you can kind of operate like this if you have a base, but you got to get the launch first before you can kind of really focus on what we're doing now.
Absolutely. And I think growth in particular, like profit and retention and clean data, will arguably be pretty consistent regardless of stage of practice, but it sounds like growth is going to be the main thing that varies depending on where you are in your client base.
Yeah.
Okay. Nathan, what about you? How do you approach this formula?
I was just thinking about reflecting back on our transactions. So I've actually gone through evaluation and taken a look at what does an outsider or an investor look at when they're looking at practices? How do they frame value? And Jack and I have had a lot of conversations with these valuation firms over the last couple of months on the clean data. That's one of the biggest complaints we hear from a lot of the valuation firms, is that part of the reason why evaluation takes so long for them to complete is the data is a mess for most of their clients. You have to pull demographic information and portfolio data and information on your employees and the business structure and financials, and everybody measures it a little bit differently. There's very little standardization across the industry, and that's that's a big reason as to why that process takes so long. But now, having gone through evaluation, I think one of the things that I reflect on is I think it could be a valuable exercise for somebody that doesn't even want to have a transaction in the next couple of years, because there were a number of, when we went through the process, there were a number of factors where they said, hey, these are areas that are helping your value. We're assigning a lot higher value to your firm because of these. But there, you also have these other detractors over here. And most of those, if we were to go and fix the problem, would have probably taken us 1, 2, 3 years, right? And so I share that just because even if somebody's not going to have a transaction tomorrow, I think sometimes going through that process and having somebody really examine your organization can give you the runway to potentially remedy some of those things.
All business owners are perfect, though, right?
Of course, yeah. We all have perfect books, perfect records. There's nothing in there that could possibly be a detractor for any normal practice. Because you've been through a major acquisition, and let's assume for conversation's sake that the valuation company is going to take care of the clean data element. They might have a brutal experience in doing so, but let's say that the acquirer is going to get a pretty clean slate, right? They're going to have good data. Then of the 3 remaining, growth, profit, and retention, how would an acquirer rank these 3? Is one more important than the other? Are they all equal?
From my perspective, I think they're all important. If you have high growth, but you're not retaining, if you have bad retention, you have a bucket that's taking, that has a hole in the bottom. If you're growing but also retaining, but your overhead is way too high, you have a profitability issue. Part of the attraction from an outside investor is just the margin that some of these organizations can have from a profit standpoint. So I think, at least having gone through the valuation, those were all very important components.
Well, and something I would say on growth, because profit in my mind is flexible, which means like right now we're going to try to hire up for what we see coming. So I'm going to reduce profitability to expand our team base. And at the same time, retention, I think, is crucial, because to Nathan's point, like if it's 2 in, 1 out, 2 in, 1 out, there's a giant issue that has to get completed before you even focus on growth. But realistically, a strong growth engine. So like I know some other firms, and even firms that are users of Vitals, that they're aggressively investing in growth because they have a seminar channel, a social channel, or something, and they're bringing in enough that they see, hey, the capital is worth reinvesting back in this growth engine that I have. And at some point, and maybe it's when their firm gets to like our size, we say, hey, I don't need to be spending this amount of money on all this excessive marketing now. I can dial it back and change the structure of the practice. Like obviously you don't have a lifestyle practice that has a giant retention problem, but if you're going to have a lifestyle practice, you're going to be more profit focused. If you're scaling, you're going to be more growth focused. So I think some of this is also what's the goal of the operator of the firm and what direction do they want to take it? And then you pull the levers. But if retention's bad, maybe make that word red.
Yeah.
Because if that's a red, that's the biggest problem you got. You got to solve that first.
Yeah, I agree. I think the problems and the opportunities are not evenly distributed. There tends to be a much larger opportunity in growth because of how much you can excel in that arena. Retention, you can kind of get up to 0, right? So it is not an infinite improvement to your practice, but it's probably the one that can cause you the most problems, and profit probably lives somewhere in the middle. And I love that I learned this a year late than that I of all people am behind in this. But when we break down growth to traffic and close rate and we look at traffic, I actually just recently learned that there was a massive acquisition that happened based on a YouTube channel. And that was one of the main parts of the dialogue around this acquisition. 597 million in assets under management acquired by a $12 billion firm. But everything that was coming through in the commentary was that the main thing that they saw as the differentiator was the YouTube channel. And Safeguard had 67,000 subscribers, which maybe in my kind of rarefied world doesn't seem like a huge amount of followers, but like that definitely was a big component for them, was around driving organic growth. So I agree with you that they're pretty evenly ranked when it comes to the valuation, and any one element of this formula can totally break your valuation, right? You need to focus on all of them, and maybe picking one as your primary focus is good. But I have definitely seen a proliferation of this idea of the organic growth funnel, right? And so, Jack, I would say you have built an unbelievable organic growth funnel. This doesn't need to exist on social media. This doesn't need to exist in seminars. It can also exist within your client base and within your referrals, right? So, Jack, would you possibly be willing to, you've done a great job of it so far. Do you have anything you would add on your organic growth funnel? Are there things that you think are really contributing to that?
Well, and I think this is the whole allure of, if you can see somebody before you work with them. I remember this is kind of interesting, but we've been using Wealthbox for almost 10 years. And I remember I went to the XYPN conference, and one of the guys that does all the training videos was at the bar next to me. And I was like, wow, like you're a real person. So, I've been watching his videos for 10 years as I'm learning how to use the tool. And so I think going back to this organic growth, like people will get a taste for me, my planning style, how we operate with clients by just coming to an event. And, the nice thing is, if you show up at an event that's at a nice place, you can bring your friends and family. Everyone's having a cocktail, so it's a little looser. People get the ability to kind of take the shields down and get away from like this sales mentality, and they're just getting to know the person. And I think with more social content, so some of the advisors that are in our network, I mentioned our firm's about $500 million, but there's another 3 billion of advisors that partner with us. And some of them all they do is digital. They're just on LinkedIn talking about XYZ employer that they know the benefits better than everyone else that's there. And so when a prospect comes to them, they know that advisor, like they've probably seen 15 of his videos. They already know what they're about. They know their background, how they talk. They know jokes and things they might say. So I think from our standpoint, just being available for people to see before there's a sales agreement. And so this is what we're actually working on next. We hired someone internally to help take these events, digitize. If I'm talking for 30 minutes on stage on some financial planning topic, there's plenty of ways you could chop that up, distribute that on social. And now we've gone from an in-person experience to a digital experience. So that's where I'm trying to put my next probably 12 months of marketing efforts, is how do we digitize stuff that's really in person? AI is not going to disrupt our in-person events, which is cool too. So yeah, fun fact, maybe we'll keep doing more of those because it gets people to interact, which is fun.
Well, and that makes such a major difference. Like I see social media being and digital marketing in general being a source of scale, right? Like the examples I have up on here with videos that are in the like hundreds of thousands of views. I see that as like, okay, I can take a couple of months to plan out and really effectively execute an in-person event. And it's going to have a very, very high close rate across a small group of people, right? Or I can spend that time investing in digital growth. I'm going to achieve a much, much higher amount of impressions, or I'm going to catch a lot of attention from new people, but my close rate might be significantly, significantly lower, right? And so how do you kind of balance those two? Nathan, how did you guys grow over the course of the last 5 years?
So Jack touched on this a minute ago, but the first was we had a very niche focus. So we specialized in providing wealth management services to technology professionals, specifically at Microsoft and Amazon. So we would say we work with, if you're a principal level 65 at Microsoft or a principal L7 at Amazon or up, we are your shop. And we produced every piece of content, whether it was digital or blog posts or social or videos, was all focused on that really specific group. And so when we met, like even if you went on our website, the landing page had, RSU grant date and after tax mega backdoor Roth 401k, right? Like all of the vernacular and terminology for this really small little niche. So our ability to build rapport was took a lot less time because we understood their specific problems. We spoke their specific language. We probably already knew people inside of their department or organization that we could, had some social validation with. So having that really specific niche was a big component for us. One of the things that kind of drives me nuts is sometimes I'll talk to financial advisors and they're like, "Oh, we specialize in working with business owners, doctors, lawyers, and high net worth families." And I'm like, "Oh, okay, duh, like everybody else."
Yep.
So I think the mistake that's made sometimes is people get afraid to get hyper specific on their niche because they feel like they're saying no to everybody. The reality was for us, we still got the doctors, the lawyers, the business owners, mom and dad that were retired. We still got them as clients, even though we were really outspoken about our niche. So that's one. The second is we wanted to create a business where the organic growth wasn't dependent upon the owner operator. We talk about like all these different growth channels, whether it's video, social, blogs, et cetera. But I think the more that you can ensure that the company grows outside of just the referrals that the owner operator gets, the more valuable your organization will be. So, for example, there were numerous years where our non-owner, so employee advisors, brought in a significant amount of the net new AUM. So not only did we train advisors to service and retain the business, but how can we also teach them to go out and hunt and bring in new business as well? And so we invested really, really aggressively into our team members. We spent a lot of money to help get them trained, educated. We had a full, every Friday was a training day in the morning. And so to grow that growth engine outside of the owner operators is a big reason why we grew as well.
Yeah.
And Nate, that's the answer in my mind to your question of like, how are these certain firms that seem to have uncontrolled scale? And it's exactly what Nathan said. Is like, if the owner is the important part and the closer and has to handle the client relationships, there's never any scale. It's once you almost become irrelevant in your organization, then you can pour, marketing dollars on top of it. And now you have this massive scale because you're plugging in another advisor, show the advisor the process, bring the clients to that advisor, go on to the next one. And so if you look at most of the firms, the people that are on CNBC, the people that are at the conferences talking, like, they're not doing that because they have a massive client base. It's because they've delegated to awesome people that are just crushing it. Great client retention, great client satisfaction. They're really adept at bringing in clients, closing clients, and maybe even they're good on the social side. Like if you're not good at social, can you hire someone that can come in that really is good on social, and that person helps you expand that route? So the team is the only way you're going to get it going.
Yeah, I absolutely agree. And we've been really surprised by that at Sage because we obviously knew that independent, like solo advisors would be a great group of people for us to help with video because they have the ability to be the personal brand of their brand. The part we didn't expect as much was having multi-billion-dollar organizations start to adopt at the team level and say, well, if I can do exactly that, if I can take marketing and spread it across my entire organization, enable all of my advisors to start producing videos, that's a totally different conversation. I just talked with one of them and he was like, okay, well, let's do the arithmetic really quickly. If you can take my top 50 advisors and you can teach them how to create digital growth funnels that turn into $20 million each per year in new assets, that's $1 billion for the firm. And in his words, he was like, that's worth some cash. And I was like, I agree. That makes perfect sense in my head. Thank you for seeing the vision. And I think very much like the connective tissue of everything we've talked about when it comes to growth and training the team, and what are you doing digitally versus what are you doing at the events, whatever it is that you're doing on the growth or the traffic side. At the end of the day, we're really trying to build as much trust before the first meeting as possible, right? Even better, more trust before we get into anything that could even remotely be called selling, right? So the more they trust us when we hit that conversation where it's like, hey, Nate, this is how much your one-time planning fee is going to cost, right? That being the bottleneck for you, Nathan, where, okay, if I can build a massive amount of trust before we ever have that conversation, then that will be a lower bottleneck. That will be something that becomes that much easier. So Jack, how would you say you guys are improving the amount of trust you're building before someone actually has a conversation about being a client?
Well, and I think if you're really focused on getting referrals out of your client base, you have to get, you can't just be like reactionary and just give them like an investment update quarterly. So we tend to get as deep as we possibly can with clients, especially on the higher end. And I know we'll talk about segmentation a little bit, but part of that becomes, when we went through and you start looking through your demographics of your book, and you have a bunch of 80-year-old clients and they have 2 or 3 or 5 or $10 million or more, you should know all of their kids. You should know them very well. You should know the name of their grandkids. If you can't do that, then you're so disconnected from the family tree that is a flight risk. So for us to build trust, a lot of this with the style of business we have is I need our clients who may be the grandparents to trust us enough to let us talk to the kids. And so we will have discussions cross-generation with the family. If we're having our events, anyone that gets referred to us from any of our clients, regardless of the size of their assets, we'll have an initial meeting with them and we'll do like a rough plan without charging them. Because we figured, if your friend or your neighbor or whoever or your relative is working with us, you should know kind of what's behind the curtain before you sign up and pay for it. And so we want to make sure that transition for, hey, I'm going to refer you to see Jack or Chris or another advisor at Senge, like go see what they're cooking and what's on the menu and what the experience is going to be like. Here's the client portal. Here's what we use for banks. Here's kind of what we do for meetings. Here's our upcoming event schedule. All that's available to them so they know, hey, if I'm shopping 5 advisors, Jack and the team are pretty casual. They're easy to work with. I have 3 friends that all are involved there. We're all in the same community. They have this event that I'm going to check out before I actually sign up with them. And so before we even make a recommendation to them, we've already had 5, 6, 10 touch points. And I think that's the best way to do it. I think for us, going back to this, getting more of a digital presence, I think the more you can blend the two of them, Nathan's practice was more of a remote practice. Most of our people are in the office and our client base is pretty much in the area here. But if you can blend both where, hey, the clients are concerned about markets, you're putting out content, they see that content, they can share that content. You're now starting to get trust building up across the board. And then, it's very common for us to have a prospect show up and just be like, hey, I work with Tony. He's one of your clients. Here's my account statements. How do I get started? And that's the first meeting. We're like, okay, I can take these all day long. These are softball pitches.
Right.
But you've been doing the reps up front. The abs don't come immediately. You got to work at it.
Well, and the hope of doing the training is that when the race comes, you feel ready for it, type of thing. Mm-hmm. It feels far easier. And that, I think, is the biggest impact that I have seen with advisors that have really good growth funnels is you have more touch points, you have more trust up front, and maybe you don't necessarily get 100 times as many meetings. Like, it's not about how many meetings you have. It's about how many of those meetings can be layups. If I'm going to have 5 meetings in a week with potential clients, if 3 of those are layups, my close rate is no longer going to be even in consideration, right? And then again, as you were mentioning about training the team, once everyone is in a position where they are serving layups and are feeling really good about their sales process, now we can really start to dial in growth. What happens if they have 10? What happens if they have 15 of those meetings? And Jack, I'm very curious to hear your thoughts on service cost and attrition with what you mentioned about how engaged you are with the next generation, with the other people in the family tree, because I see that as such a major flight risk. But before we talk about that, we'll talk a little bit about revenue and service costs, because Jack, you actually got me thinking about this when we met a little while ago, where there's this typical like Pareto principle that everyone kind of applies to practices, where they say 80-20 rule. 20% of your clients are going to provide 80% of your revenue, or they're going to provide 80% of your referrals, or they're going to provide 80% of your headaches. And while I agree with that, and I like it as a rule of thumb, I think it becomes a very, very bad way to start to make big decisions for your practice, right? Because you could say, well, I could just take the 20% of my clients that yield 80% of my revenue, fire everyone else, and then I would have most of my practice and significantly less work. I can use that bandwidth to go and get more clients who are like the ones that I kept. But then you get into a data-driven application where it's like, yeah, but X percentage of these clients are profitable. Maybe they meet with me significantly less, or they require less of a tech stack because their case is far less complex. And so they might not be in that top 20% revenue wise, but they might be in the top 1% profit wise, and not really understanding and being able to effectively know both revenue and service cost causes you to make really bad decisions. So Nathan, because we were talking to Jack for a little while, what are your thoughts on this? Do you think the 80-20 rule holds? Do you think you need more?
We measured this. For us, it was the 80-50 rule. So 80% of the revenue, I think it was actually 85%, came from the top half of the book.
Okay.
But I agree with you. Like, we didn't use that as a way of cutting people off or terminating relationships, because to your point, a lot of those relationships were, even at smaller AUM amounts, were highly accretive because the service requirements were so low. Their situations weren't all that complex. I think as well, depending upon what the advisor wants to build in terms of their firm structure, do they want to build an organization that has other service advisors that are managing their own book of business, that are trying to retain a book of business, but also learning how to grow their own independent book of business? Some of those smaller AUM relationships are great ones to hand off to those new advisors for them to start to learn, because the risk to the firm is pretty minimal. If the client gets frustrated and decides to leave, it's not the end of the world. It's not going to bankrupt you. And it's a great way for that G2 to start to make some mistakes and start to learn what is it actually like to manage a relationship and to build trust and rapport and to go find other opportunities and to grow. So that depends, I think, on what the structure of the firm that you're trying to build. But I agree with you. I think it could potentially be a mistake to just cut a lot of those relationships, because there's probably some hidden gems in there, one, and two, it could be a great training ground for the next generation.
Yeah, I agree. Absolutely. I have a client who came to me, found me on TikTok, and was working in an assisted living facility, making very, very little money. And she was like, look, I just want to start to practice. I want to start to get good at this whole personal finance thing and see if I can start to make a pretty serious difference on my life. And fast forward, she was able to write a book on Spanish slang and sell it through Amazon self-publishing and on TikTok Shop. And she went from about $4,300 a month to $400,000 a month over the course of about 3 months. And became a totally different client, became a much more complicated, engaging case, and obviously went from someone who was in the absolute lowest percentile of our revenue or profitability per client to one of our largest clients very quickly, right? And I think that was it was just a very exciting thing, where we might have looked at one of these broad rules of thumb that you use when you don't have the data to do anything else, and you start to make mistakes as a result. So the more data you can have to better make those decisions, the better off you're going to be. And I think there's also this duality where, for us as advisors, there are certain things in our business that we can measure really, really easily, right? We can just figure out how much revenue we're making. That's a relatively easy number to calculate, right? You could probably even start to calculate the value of the referrals that you're getting from a given client, or the value of the testimonials or word of mouth that they're providing. So revenue, I would argue, and I'm curious to get your guys' take on this, revenue is generally easier to measure than service cost. Jack, what are your thoughts?
100%. I mean, there's so much. I mean, how many emails do you reply to in a day? Like, and then how do you quantify that? I don't know. We use some text messaging applications too for clients, which speeds up the frequency of how often they can contact you, but that's still service costs. So, there's that, preparing for meetings, preparing for events, preparing for business development, training. I mean, there's so many things that are in there that are kind of, how are you going to measure them? You're going to have to ballpark them, and your revenue's defined. It's, you get a tax form with exactly what your revenue is. So most advisors know that like the back of their hand.
Yeah. I don't want to put you guys too much on the spot, but obviously I added a lot of things to this list, and these were just the things that I could think of off the top of my head that I kind of include in my service cost, right? There are big ones like emotional intensity and cognitive load, performance expectations, like someone pegging my performance against the S&P 500 and how closely they measure those types of things. Those are much, much harder to measure, but I was curious to know if there are certain service costs that you guys think are both unbelievably important to the business to know and really hard to measure. They don't have to be on this list, but I'm curious to know if you guys can think of any.
I was actually, Nate, maybe I just throw the question back at you, because I was thinking about this as it relates to marketing. All right. And so we talked about, your marketing spend. Maybe you're spending money on paid ads, or maybe you're spending money on producing video content or whatever it might, or with a marketing agency. But hidden underneath that are those soft costs associated with marketing and business development, taking prospect meetings. How much is the advisor spending a couple hours a week recording videos or writing blogs, right? How do you guys take a look at not just the hard costs associated with marketing and growth, which are very easy to measure on a P&L, but also the soft cost components, the time and the expense for that, and using that to determine things like ROAS, customer acquisition costs, et cetera?
Yeah. I think it was the CEO of Coca-Cola back in the Mad Men era who said, I know that 50 cents of every marketing dollar is wasted. The problem is I just don't know which half.
Yeah.
I think that's so accurate and so spot on, because I definitely feel that way with a lot of our marketing, where we know that a lot of the things that we do are going to have a positive ROI. And we also know that a certain percentage are not going to have a positive ROI. But what we find over and over is that when we get rid of the things that don't have a positive ROI, it reduces the ROI of the other things, right? A super easy example is with paid ads, and this is fresh in my mind. Just because we started running another campaign as a business, picture like 5 videos, each one is a different paid ad, right? 2 of them are performing unbelievably well. 1 of them is middling, 2 of them are bad, right? So what do? You take 2 of those videos away. You take the 2 worst ones away, and you just put all the money into the 3 that are working better, right? Well, the cost per acquisition doubled, and the total number of impressions fell aggressively. And so you look into it and you say, oh, okay, these other 2 videos had really bad conversion rates and they were really expensive from an ad perspective, but that's because they were operating as top of funnel. They were being shown first. They were warming people up who inevitably converted on a different ad, right? I feel the exact same way about marketing. The problem is that it's much harder to measure like a digital marketing funnel where you're not paying for paid ads, because you can't see, like Meta isn't going to tell you how much it cost for you to get each lead, right? So this is kind of how I approach it. I figure that at the bare minimum, 10% of revenue should be spent on marketing as an organization, right? There are some that would argue that it should be 30 or 40%. And so taking that 10% and making sure that I spend it is honestly the most important component, because I want the 50% of the marketing dollar that does work to be present, right? Because otherwise it's just going to be zero. So I start there and I say, okay, I know that I'm going to allocate this much budget, right? And then I'm going to take that and I'm going to split it across a couple of different polar opposites. So I'm going to do a podcast, but I'm also going to do short form video, or I'm going to do mailers, but I'm also going to do in-person events, for example. And what I will try to do more than anything is I will try to measure how those interact with each other. So a really easy way to do this is on your booking link. So someone comes in and actually books a call with your team. Well, you just have you have a field in there, not a set of radio options, but an actual field that just says, how did you learn about us? And what we extract from that is not just where they converted. I converted because I watched one of your webinars. I converted because I listened to your podcast. Instead, they will explain that messy middle. It's like, well, I saw a webinar first, but then I went to your YouTube and I consumed as much of your content as I possibly could. But it wasn't until I saw you at Future Proof that I actually gave you my information and we started having a conversation, right? I think that's the best way to track ROI, is thinking about the funnel as like an interrelated thing, which for you guys as very data-driven people is probably like the antithesis of what we should be shooting for. It's like, no, how much is the email ROI, right? It is much more about this melding, this web, this digital mass that you're creating for yourself, and then finding one thing that converts exceptionally, exceptionally well. You don't stop doing everything else. You assume that everything else is helping, but you invest the new dollars, the vast majority of future investment in that one thing. So Jack, for you, maybe you guys have some blogs that go out, you have some marketing that you do, you have some emails that you send out, you have a little bit of digital mass, that kind of thing. Would you stop that because you want to invest more in like high-end events that clearly are one of the main drivers of business for you guys?
No, it'd become an additional marketing outlet is what it would be. So we know what's working, maintain that. And what I was going to say is like all these costs that are in there, all these soft costs, like if you spend all your time trying to quantify them all, you're not going to do any business to begin with. You're not going to be servicing clients. So it's, my approach is automate what can be automated and then just kind of like assume gray area. Like if you expect Claudebot's going to come in and automate all this stuff for you, and then you get a clean report at the end of the quarter that just says, oh, just dial this up, dial this down. It's not going to work. It's going to be so messy. And the more we've been in the data business, the more we've seen this. But if you have some rule of thumbs, like we know exactly the type of event that if we overpay on like a per plate, if it's like a seated dinner type thing, we know what the food and beverage cost is going to be. And we know what amount of AUM we need to bring in to actually get an ROI on that. And then we've done some other stuff where it's like, hey, we're just going to load them up with hors d'oeuvres or get a bunch of food trucks to come to an area and have some sort of indoor outdoor event. The cost is much, much lower. And now we can broaden the segments we invite to that event. And so we know what those spend ranges are. If we're going to bring in social, we're going to bring in ads, it's adding on top of that layer that already works. I'm not going to dial one back that's already working to start something new. We're just going to add it and see if that adds more value. And then we'll throttle the new layers to a higher level.
And you raise a really good point that I don't think I said very well when I was talking through tracking your marketing, is you have to know exactly how much you spend, right? So that at the bare minimum, you can tie the total amount that you spend to the new assets you get from a given funnel, right? Okay, so across YouTube and TikTok and Instagram and Facebook and LinkedIn, we got $2 million in net new assets this month, right? So therefore, spending the $2,000 made sense because we can tie the actual new assets to the amount that we were spending. And that's the nice thing about marketing that is very different from, of course, everything I have listed here, is that everything about marketing has a pretty specific dollar cost. I think that the time is the only missing piece there, right? How much time do you spend writing the blogs? How much time do you spend making videos? That sort of thing. But it doesn't end up being that much time relative to the rest of the practice, right? That becomes a very small component because marketing is expensive and the time element is relatively low versus like a client, it might be the opposite.
If you spend time trying to calculate time, you have to also account for the time that you're spending trying to calculate the time. And it's like an inception thing where I think you can kind of do the painter's thing. You kind of like eyeball it. And you're like, yeah, it's the shade of green and just slap it on the wall and see what happens. But I think there's the paralysis by analysis, which is huge. And I know some advisors that try to min-max their perfect financial statement on how much are they spending and dollars spent. And they're trying to get this CFO style quality into their analytics. And it's like, you could have probably just rounded, thrown it at the wall and focused more time on redeveloping your team or, rolling out a new revenue source for clients. So with the service costs, one thing we realized if we have a very high touch business, a client event is a good way to do 200 meetings at one time, because a lot of people will not come in for a meeting if we cover enough topics for them. And then the events, whatever, 3 or 4 hours, they can get time with us. They can ask all the questions they want, and then they don't even want to come in for a meeting. So we'll do a really comprehensive meeting up front, and then we might not see a client for a year or two. And that's actually common because they're like, oh, I've seen you 6 times this year at events. And so for them, that's enough touches, enough trust that they know, hey, I've talked with Jack, I've talked with the advisory team. I know what they're doing. They're telling me everything that they're doing inside the accounts. There's communications that go out. I meet with them when I have like a big problem that's there. But for us, that's a way for us to take our service costs. Instead of saying every person gets an hour, some of those are going to be in the red. So can we use this seminar to get, 1 hour covers 30 people, and now we have, minutes spent on reviews, which is good.
One to many with your clients. I like that approach a lot. And I'm sure, you could do the arithmetic to figure out how much money that's saved. Is that in your cost benefit analysis and your spending ranges for events? Are you including the hourly?
We have some details on this. We haven't gotten too granular, but I've always thought there was probably an opportunity to have like I was thinking like CrowdStrike. I was like, you could have crowd plan where you just like, everybody's in a cluster and you just hop into a webinar like this, answer a bunch of questions, and then sign off for the day. I'm like, I think a lot of clients, probably more self-directed people, would sign up for a service like that, where it's like the doctor's available from 9 to 10, ask whatever questions you want. You're around similar people, so maybe you'll get similar responses. But so far it seems like most people, especially if you're segmenting your book right, which we do a lot of work on segmenting. That's a core feature we put in Vitals. Somebody doesn't have segmentation, we'll at least start them with something. But we know which clients are worth the time and which clients shouldn't come to the events, because it's going to put us in the red. And so maybe the client has $10,000 with us, but their network, like we have one of the advisors in our group, he has a client who's like 26 and her parents are like worth $7 billion. So she comes to every event that's possible just because she swims with people that, are way above everyone's pay grade. And so in that case, this might be well worth spending money on. And, I don't want to say like we don't want to uninvite people, but there's certain households that we need to have a virtual relationship or meet once a year at most, because that's all really the revenue can really provide to that person. And we don't want to get into the red.
So you might, like, if we're looking at the chart on the right side, like you might invite clients 1 and 2, where you have like a high profitability, but maybe a lower revenue client. And then you have a really high revenue client, but then like the one that's in the red on the far right-hand side, like that might not make sense.
Yeah. So when we segment it, we use like the, platinum, gold, silver, diamond. We added an emerald category, which is basically like, these are people we just want to have as clients. And honestly, I don't even care if they're profitable or not. Like, these are so well connected, or this person works for a company or started a business and we know the valuation's insane. So if there's a liquidity event, this person's going to go from worth $1,000 to $45 million. Like, I'll take the ride with them, and that becomes marketing expense. I'll bring them to our events. We'll have meetings with them. So we've collected a lot of those. A lot of times it's a very wealthy household and the children will be emerald. So we want to make sure, hey, anyone that's in this band, there's a high opportunity that either they're downstream from wealth or they're growing into wealth. Some people call it like their Henrys or something like that. Those are the ones, they can come to the events, they can come to, meetings. We can, we're not going to really track profitability. It's the ones that are in our core subsets where I think we've got everything from this client. We had 100% of wallet share. Now we need to look at service level versus profitability.
I love it. Okay. So I think service cost, we covered. That is a really awesome way to approach it. Nathan, anything to add on here before we go on?
No, the only other thing I was thinking about, guys, was as people are thinking about marketing spend, I think the default is for most people to think about it in terms of new client acquisition, like how am I getting new households into the firm? I imagine there's a lot of that marketing spend that helps to bolster retention rates, which I know we're going to talk about, I think, here in just a second. So, continuing to put out content that's relevant, that's super high value for those existing clients probably helps to retain that client. If you actually look at the LTV of the client relationship, for a lot of firms, it's a significant number. And so even if somebody's not trying to bring on a ton of households, which I think most firms are, but even if that was the case, there's a strong case to be made to invest in marketing and branding so that you can retain the already existing relationships you have. Because those clients are watching, they're reading the blogs, they're watching the YouTube videos too. It's not just prospects.
Yeah. One to many.
And it tees up really nice referral moments. Like that was Skylar back here. Like when he started producing videos, it was really just a referral engine for him, and still is. Like it was just a new way for his clients to, instead of saying, oh, you should reach out to this person, like, no, I'm going to send you a video. This is my advisor talking about this thing that we were talking about yesterday over lunch. And that has been a really amazing avenue for him. I 100% agree with you that there are these downstream effects of having marketing that are really client focused rather than just entirely prospect focused. And that's the part that has always bugged me about marketing, is that like the most profitable marketing tactics or the marketing strategies have a negative ROI for a very long time, right? Talking about organic content, talking about paid ads, talking about email marketing, these things that large established firms can do at scale and be unbelievably effective at, and it can just scale for as far as you would like it to go. There is this long period of time where you end up in the negative, right? And for a lot of advisors, that's a hard thing to stomach when there are other options. Like, well, I can go and do a seminar and I can get 2 clients, and at the bare minimum, I will be profitable on that event, right? Am I going to onboard 20 clients this month? Probably not, but I'm not going to be in the red on anything that I do. All right, Jack, you had really good notes on attrition and talking about engaging and having emerald clients that are the kids, and making sure that you know and are familiar with everyone in the family tree. So before we kind of dive into this, what ended up being a relatively complicated chart that I threw together here, I'm curious to get your take on some of the best strategies people can use to solve attrition, and what attrition they should be looking at and measuring to understand their net new assets.
So this is a hard one, but I think there's a couple components that need to come in. First is like, what is the average age of your clients? Obviously, if they're 70 plus, then required distributions is always working against you. So that's part of it with net new assets. With our firm, we like to track the distribution rate globally. So what's my book? What's my distribution rate? What's my brother's? What's his distribution rate? Because if he's taking, I don't know, let's say it's 4% or something that his average book is drawing out, like you got to just bring that back in to get back to even.
Yeah.
And so, there's the net new assets component, which I'll talk about. That's a report we've been working on internally with Vitals, was how do we automate collecting that? Because it's difficult. You're exporting transactions from the custodian and from performance reporting and going from there. But something else that we do is, and this kind of goes back to getting the multi-generational planning underway, is we do track when a client passes away, how much is retained. And a positive sign for us, we actually had one of our largest clients, the husband passed away last year. And when the husband passed, everything went to the wife, who's still a client, but we also picked up all 3 of the kids and 2 grandkids in that event. So the part of the planning process for us was our net new clients went up. It was about 6 new clients when 1 passed away. So we net 5. And now we have, that if you think about from the valuation thing we talked about earlier, is a buyer is technically buying how long they think this client is going to pay you. So the lifetime value of the client. So if I've now just taken the age demographics for this full household from 80, and now it's closer to 50, and then I get the grandkids, it's closer to 40 or 30. Now we have a real stability to retention and tracking attrition. So now when we're looking through this, if it's an older client, and then we go through our segments, maybe I'm not so concerned about a small client that doesn't have any assets left over, and I know the kids aren't going to do anything with us, or maybe they're a difficult client you've had for years. A lot of times we're not going to go as hard after that, but some of our like pinnacle clients that have been around for a while that we have great relationships with, that kind of helped us build our firm, we want to make sure that all of the kids underneath them, the grandkids, can we talk to their neighbors? Like, how connected can I get to this cluster? So if something happens and there's an event, we don't lose it. And if we're high touch like we have been, we're not really losing somebody where, my first job was working at Fidelity, and you're just taking endless phone calls. So you have zero relationships with any person you're talking to. So it's like, hello, goodbye. And you'll never talk to that person ever again. So retention was a complete mess. But if you're having ongoing conversations, and we have clients that used to babysit me when I was a kid, that relationship's not going to go anywhere. Can I develop that relationship and improve our net new assets? So those are some of the things that we're tracking on the back end there. Where's the revenue coming back at? Things like that.
Yeah. Okay. Tell us, if you're willing, about the net new assets report. What in the world do you put on a report? I could see it getting so complicated so quickly.
Well, so if you look at net new assets, so a lot of places will provide you a net new, but they're just looking at your book. So the problem with that is, it's like, okay, you started your assets under management at whatever, let's just say it's 50 million. At the end of the quarter, it's 100 million, or end of the year, it's 100 million. So you went up 50 million. Well, maybe all of your clients were riding in AI tech stocks, and that accounts for the entire market growth. On the flip side, maybe there's required withdrawals coming in. One of the things we do is we try to get clients, when they come on board, to automate their required distributions to a taxable account. And then we use the taxable account to manage their cash flow. And part of what we were doing is we found we were sending way more money to clients that would eventually come back in 3 years. We're like, well, let's just keep it all here and then focus on the cash flow that they need. But we're the net new is just coming right back in. It's not like we're at a loss at that point. So we built a simple report, and I could show it at the end if you want to see a little tutorial of it. It's actually going to launch this week. So this will be the first place we show it. But you'll be able to, for Wealthbox, Redtail, or Orion users, and we're going to expand the integrations for it. It'll automatically calculate net new assets every month. It'll break it down by segment. If you're segmenting your clients, it'll break it down by advisor of record, and it'll give you a household breakdown. So we can see what the actual start to finish over the period net new assets were for every household. And one of the things I wanted when we built Vitals was like, I don't want to make these reports. I don't want to spend time in spreadsheets. So let's get some engineers to look at all the systems I'm using. Can we pull out the data and just automate the reports? I know what I want to see, but I don't want to make it every quarter. So how much of this can we automate? So that's been the most requested report we've had, is just give me like a pulse check of how I'm doing every month without me having to go in there and pivot table it.
Yeah. Well, I want to take a look at it for sure. Nathan, do you have anything to add on attrition, or ways to either measure or reduce attrition?
The only thing I'll share that was valuable for us before we go into the demo was we would offer what was called, just in the lane of multi-generational planning, we would offer what we called family billing. So we would aggregate immediate family members for billing purposes. So if you had 3 siblings, or mom and dad plus they have a child, let's aggregate them all together for billing purposes so they can all participate in a discount. That makes that relationship really, really, really sticky. Because if any one of those individual family members go to look at another competitor, their cost for that service, for the same service, is likely going to be significantly higher. So we would get a lot of those parents that had good AUM with us. Let's say they were paying 75 basis points with their son or daughter that maybe otherwise would pay 150 basis points if they were on their own. Well, we'll just grandfather them into the family rate. They'll pay significantly less. They're not going anywhere.
Yeah. That's brilliant. All right. That is a great idea. Thank you for that. The final piece we have on here is the fact that clean data is obviously going to multiply all of this. We can solve growth in a number of ways. We can solve profitability in a number of ways. And of course, we can solve retention. And I want to thank you guys for having put so much forward on great strategies to solve all 3 of those. But if we can't see it, we can't solve it. So I'd be very curious to actually take a look at Vitals for a couple of minutes and see that new report. So I will pull this off the stage, and then you guys should be able to present. The
other thing I was going to say in clean data is we've bought books over the years. I would have, in hindsight, paid more for clean data, because sometimes you acquire a book and away you go. All right, so let me share my screen. I'm learning this as we go.
No worries. StreamYard, as usual, is just new tech. There's always something to be figured out.
All right, let me know if you see my screen.
We've got you.
Cool. So this is the dashboard for Vitals today. So anyone that's been an advisor, like I don't want to spend any time building anything. I want to just sign up and it works. So the dashboard today is static. It'll be customizable in the future, where whatever key performance indicators you want to see are going to come across the top. You can sort the advisors in your firm. But I want to get just right into the reports. And first off, for setting this up, like getting real data is hard. So we wanted, if someone's using Wealthbox, just click connect and we'll pull in all the data from Wealthbox for you. You don't have to worry about download, upload, all that stuff. We just connect right in, ask a couple of questions to map your data. We realize a lot of firms don't use Orion for performance reporting, so we're going to have a CSV option for people that want to export from the custodian to see their data. And then we let them segment that data in our system at the bottom. There's a workflow for that. I want to talk clean data though, because one of the things we realized was if you go pull a business intelligence tool, a lot of times you don't know where it's pulling your data from. So we figured let's put it right in front of the advisors or their teams. If they're householding it, there's a little toggle so they can see who's in a household. But at the same time, we wanted to score all of their records and what's missing. Because if I tell you how many clients don't have an inception date, you can't really track lifetime value of a client, or you can't track your client onboarding or any of that. Same thing with birthdays. If you're missing birthdays in CRMs, segmentation, no address, all of your key performance indicators connect to something inside the record. So we want to make sure that data is available. And I know we talked about this, but one of the things we found was like everyone we connected to, they're like, oh, it's all bad. My score is 50. How do I correct it? So we made the ability where anything in our system, if you click on the contact in the client table, it'll show you what's coming in from Wealthbox or Redtail. If you're using Orion, it'll pull that as well, and you can edit on the fly. So we want to be able to spot bad data and just fix it quick and then get back to what you're doing.
Nice.
Reporting. I don't think advisors want to build reports. I mean, if you look at my Wealthbox, there's probably like 500 reports we built, and I probably don't use any of them. We built one and then we decided to build another one when it works. So we wanted simple reports that you just click a button and okay, now I have my client age demographics by segment, but I can also toggle in my assets under management. So going back to what I talked about, there's 30 million that's 80 plus years old. Let's focus on planning for that. I'll jump to net new assets. So this is year to date, but if we want to look at how we're doing based on transactions, let's just look at it across the board and see how much is market value change and how much is net new assets, and filter that by the segments of our book. Maybe we want to look at a specific advisor in the book. But then like we track our AUM, let's start tracking our net new assets. So let's start tracking maybe our net new asset growth rather than just our AUM growth, because that's really what's driving value for the firm. Someone asked us for a leaderboard. So can we rank my advisors and their market growth, also their clients and who's bringing in the most? But then a detailed breakdown, because in my mind, I should be able to search for a specific family, see all the transactions that's happening. And so yes, they had a 5.5% gain, but net new, they're actually down. So really the only thing that happened with this family was the market scaled them over that time period. And so part of the whole theme of Vitals is like, I don't think advisors should build reports. There's a whole AI component I haven't even talked about because I want to just focus on the KPIs for today, but we trained an AI model that basically understands valuation, understands some of the best concepts in practice management, and then just reads your KPIs and your data. It starts to work as a coach. So it'll start to identify clients with net new asset trends, clients with aging demographics and things like that. So the whole goal here is just to give advisors just a one-click solution to see, hey, maybe let's look at my referrals. Who are my top referral sources? Maybe for specific advisor in the office, where are his platinum clients coming from? And you can see exactly where they're coming from based on different referral sources and segments and stuff like that. So the goal is to connect to your systems, connect to your existing tech, and just help you visualize all that data without you having to sit there and build the whole problem. There's too many months I've spent in spreadsheets at the end of a quarter that I can't get that time back. So we're going to try to automate all that as well.
Man, I just wanted to plug right into Sage so that you can say, okay, here's all the analytics on my social media platforms. Here's all the analytics on my landing page. Here are the conversions that came from this specific link. And then instead of just referral sources, it's also that new business, that digital growth attribution. So you can say, well, is it worth it for me to do marketing? Yes. And I can tell you dollars.
Well, and that's part of the reason I think if you have a good process for segmenting your clients, it may further tailor how you market. If you have that emerald client base that I mentioned, that the average age is 30 or 35, they're on those platforms. They're not reading your Substack. So start targeting them with the right platforms and then figure out, hey, maybe I need to do some sort of in-person thing to get after some of these larger clients that are in this specific demographic. So we tried to make the platform as user-friendly as possible with the least amount of work. You just connect your systems to us. A lot of firms asked us, hey, can you then just upload spreadsheets? So that's what we're working on now, is maybe you're using Redtail. Data is a little hard to see. Reports are hard to make. You're using some custodian and you have the account data. Okay, let's just let you upload that and merge it in and get your analytics.
Yeah, I'm really impressed, gents. This looks really, really cool. All right. Does anyone have any questions? I know we still have a good group of people in here. Does anyone have anything you'd like to ask Jack and Nathan before we say goodbye? I did like this comment that Wayne said, where he said, I think revenue is important as in dollars, but there is a non-cash component as in I can work with this client. I get two components, cash and satisfaction. I added that to the service cost. The idea of this advice adoption, like, do they actually take your advice? Do they do the things that you ask of them? I think that is such a huge component for me when I think about a client. I mean, Jack, you gave a great example around, well, maybe this is an emerald client. Maybe this is someone who it might not be entirely profitable for me to have at my marketing events, but they swim in a different lane, right? There are these other non-tangibles. There is a component there, Wayne. I agree with you 100%. Okay. Ian also asked, can you reiterate the points made on the slide that talks about the 80-20 rule? Absolutely. I can just go back here and we can pull that. Did I pass it? I passed it. There we go. I mean, my point on this was just that if you use a rule of thumb, it's probably because you don't have the data to do anything different, and that the rules of thumb can be pretty misleading. That if you took that to the extreme and you said, okay, I'm going to use the Pareto principle to remove 80% of my clients, well, according to the data-driven application on the right side, you might have accidentally fired your most profitable client, or the one that's going to sell their business in 2 years for 45 million, to your point. Jack, anything you guys would add on this?
Yeah, I would just say revenue and profitability are two different things. And that's one of the next things we're working towards. Our whole roadmap was always start with, can the advisor get what their client base actually looks like? Then layer in the revenue. And once you have the revenue, then you start to work towards the profitability metrics, because we have some very large clients that never call and they're very profitable. And then we also have some clients that are smaller tier clients, a couple $100,000 a year. They're a friend of a friend type thing. And they also never call. And that same, is true. We have very wealthy clients that want to call and talk, everything that's happening on CNBC. They want to talk about it every day. And if you take your soft costs into account, you're literally burning all of your time handling that. So if you can get at least a good idea on workload, one of the ways we've looked at this is, can we pull out all the activities on a per client basis and just like sum total it? You don't have to be like, I had 6 calls and 14 emails, but we touched this client over the last 12 months 13 times. This client we did twice. That might be enough of a ballpark to tell you like, hey, this is a really profitable household. I should retain this. And I think as you're prospecting, I'd want to know, kind of to Wayne's point, like if someone can really work with you and like from a client satisfaction standpoint, they're not terrible. Like if people suck, I don't want to work with them. I'll just tell them now, I don't want to deal with you. But if they're great to work with, and at least the revenue stuff is somewhat, they might just cover all your marketing costs and that might be fine. So there's a lot of flexibility there.
Yeah, absolutely agree. Nathan, anything?
I just reiterate the same point I made earlier, which was those smaller relationships, to your point, to both your points, those can still be accretive. Those can still be profitable. But two, they can also be a wonderful training ground for the up and coming advisor at your firm. I do not believe in dumping, 200 awful relationships that you never want to talk to again on that person. Like, that's a bad job. But these up and coming advisors do need an opportunity to leave the nest, so to speak, and go and try a little bit on their own. And some of those relationships can be a great opportunity for them to do that. And I really encourage the owner operators to have the courage to let go and let that advisor go and learn the same things that we all learned growing up in the business, and make a couple mistakes too. So I think that can be a great training ground.
Absolutely agree. Well, that's everything we had for today. Thank you guys so much for joining me. I think this turned out to be even more of an illuminating conversation than I expected it to be. So I hope we get to do this again sometime soon.
We'll do a quarterly update.
Deal. I'm sold. Thank you guys so much for your time. All right.
Thanks,
We'll talk later. Goodbye.
Thanks, everybody.
Thank you everyone for joining.
Bye, everybody.